I'm sure by this stage you have heard of the term blockchain, especially associated with cryptocurrencies like Bitcoin and Ethereum, as they are powered by a technology called the blockchain. At its most basic, a blockchain is a list of transactions that anyone can view and verify. It is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. A blockchain is essentially a digital ledger of transactions that is duplicated and distributed across the entire network of computer systems on the blockchain. Each block in the chain contains a number of transactions, and every time a new transaction occurs on the blockchain, a record of that transaction is added to every participant's ledger. The decentralized database managed by multiple participants is known as distributed ledger technology, or DLT for short. Blockchain is a type of DLT in which transactions are recorded with an immutable cryptography signature called a hash. This means if one block in one chain was changed, it would be immediately apparent it has been tampered with. If hackers wanted to corrupt a blockchain system, they would have to change every block in the chain across all of the distributed versions of the chain. Assets on the blockchain can be tangible, such as a house, car, cash, land, or they can be intangible, such as intellectual property, patents, copyrights, and branding. Virtually anything of value can be tracked and traced on a blockchain network, reducing risk and cutting costs for all involved. Cryptocurrencies and the blockchain technology that powers them makes it possible to transfer value online without the need for a middleman like a bank or a credit card company. Due to the cryptographic nature of these networks, payments via blockchain can be more secure than standard debit card, credit card transactions, as their accuracy is constantly being verified by a huge amount of computing power. When making a Bitcoin payment, for instance, you don't need to provide any sensitive information. That means there's almost zero risk of your financial information being compromised or your identity being stolen. Blockchains such as Bitcoin and Ethereum are constantly and continually growing as blocks are being added to the chain, which significantly adds to the security of the ledger. So you may be wondering, how does a blockchain work? Well, picture a chain that has been anchored to a wall, but in this case, every link on the chain is a chunk of information that contains transaction data. At the start of the chain, which would be the unanchored side, you can see what happened today, and as you move down the chain, you see older and older transactions. And if you follow it all the way to the anchor point, you'll have seen every single transaction in the history of that cryptocurrency. As each transaction occurs, it is recorded as a block of data. Those transactions show the movement of an asset that can be tangible or intangible. The data block can record the information of your choice: who, what, when, where, how much, and even the condition. As said, each block is connected to the ones before and after it. These blocks form a chain of data as an asset moves from place to place or ownership changes hands. The blocks confirm the exact time and sequence of transactions, and the blocks link securely together to prevent any block from being altered or a block being inserted between two existing blocks. Each additional block strengthens the verification of the previous block and hence the entire blockchain. This gives blockchain powerful security advantages. It's an open, transparent record of a cryptocurrency's entire history. If anyone tries to manipulate a transaction, it will cause the link to break, and the entire network will see what happened. This renders the blockchain tamper-evident, delivering the key strength of immutability. It builds a ledger of transactions you and other network members can trust. Some of the main advantages of blockchain are: they're global, which means that cryptocurrencies can be sent across the planet quickly and cheaply. They increase privacy. Cryptocurrency payments don't require you to include your personal information, which protects you from being hacked or having your identity stolen. They're open, because every single transaction on cryptocurrency networks is published publicly in the form of the blockchain. Anyone can scrutinize them. That leaves no room for manipulation of transactions, changing the money supply, or adjusting the rules mid-game. The software that constitutes the core of these currencies is free and open source, so anyone can review the code. It increases trust. With blockchain, as a member of a members-only network, you can rest assured that you are receiving accurate and timely data, and that your confidential blockchain records will be shared only with the network members to whom you have specifically granted access. There's greater security. Consensus or data accuracy is required from all network members, and all validated transactions are immutable because they are recorded permanently. No one, not even a system administrator, can delete a transaction. There are more efficiencies. With a distributed ledger that is shared amongst members of a network, time-wasting record reconciliations are eliminated, and To speed transactions, a set of rules, called a smart contract, can be stored on the blockchain and executed automatically. There are several ways to build a blockchain, or types of blockchains. They can be public. Public blockchain is one that anyone can join and participate in, such as Bitcoin. The disadvantages of this type of blockchain is it might need substantial computational power. There's little or no privacy for transactions and weak security. These are important considerations for enterprise use cases of blockchain. They can be private. A private blockchain network, similar to a public blockchain network, is a decentralized peer-to-peer network. However, one organization governs the network, controlling who is allowed to participate, execute a consensus protocol, and maintain the shared ledger. Depending on the use case, this can significantly boost trust and confidence between participants. A private blockchain can be run behind a corporate firewall and even be hosted on premises. There can be permissioned blockchain networks. Businesses who set up a private blockchain will generally set up a permissioned blockchain network. It is important to note that public blockchain networks can also be permissioned. This places restrictions on who is allowed to participate in the network and in what transactions. Participants need to obtain an invitation or permission to join. Lastly, there can be consortium blockchains, which is when multiple organizations can share the responsibilities of maintaining a blockchain. These pre-selected organizations determine who may submit transactions or access the data. A consortium blockchain is ideal for businesses when all participants need to be permissioned and have a shared responsibility for the blockchain. Blockchains can vary in use. The original Bitcoin blockchain was designed solely to manage digital money, whereas the Ethereum blockchain is a further evolution of the distributed ledger idea. Because unlike the Bitcoin's blockchain, it's not solely designed to manage a digital money. Noted, that said, Ethereum is a cryptocurrency and certainly can be used to send value to another person. Think of the Ethereum blockchain more like a powerful and highly flexible computing platform that allows coders to easily build all kinds of applications leveraging the blockchain. For example, imagine a charity that wants to send money to 1,000 people every day for a year. With Ethereum, that would only take a few lines of code. Or maybe you're a video game developer that wants to create items like swords and armor that can be traded outside of the game itself. Ethereum is designed to do that too, and is a major part of NFTs. Blockchains will remain important as businesses run on information. The faster it's received and the more accurate it is, the better. Blockchain is ideal for delivering that information because it provides immediate, shared, and completely transparent information stored on an immutable ledger that can be accessed only by permissioned network users. A blockchain network can track orders, payments, accounts, production, and much more. And because members share a single view of the truth, you can see all the details of a transaction end to end, giving you greater confidence as well as new efficiencies and opportunities. Blockchain technology is also exciting because it has many uses beyond cryptocurrency. Blockchains are being used to explore medical research, improve the accuracy of healthcare records, streamline supply chain, and so much more. Do you use blockchain technology currently? If yes, let us know which blockchain you use and why in the comments below. If you enjoyed the video, please be sure to hit that like and subscribe button so not to miss out on more.